Let's just jump right in. Manar, welcome and a very happy new year to you.
Yeah, happy New Year, Rob. I apologize if my voice sounds a little hoarse here. I'm just recovering from from a cold where I lost my voice. But on the plus side, my wife says I've never been a better listener. So there you go.
Very good. Well, it sounds like you celebrated pretty well over the holidays then. But hey, a new year, a chance to both look backwards and reflect, also a chance to look forwards. I'm actually hoping to ask you to do a bit of both over the next few minutes. So if you wouldn't mind, let's start with looking back. And I wanted to ask you about our Moneyball process. We've talked about it a little bit on the podcast over the last few years, but can we start there? Can you remind us what that is and maybe share some of the more interesting insights that you've gleaned from that as it pertains to the global equity strategy and some of the investment decisions that we've made over the past year?
Yeah, Rob, I'm always excited about the new year because I'm just anxiously waiting for the Moneyball kind of statistics to come out because it's such a great example of the continuous improvement at More. A few years ago, it was like an experiment run by Justin and the lab team, and today it's a consistent process that we use to kind of help evaluate our decision making. And I think it's a real testament to the decentralized and evolutionary model that we have for kind of ideas at the firm. So for the benefit of the audience, what is the Moneyball that we do at More? You've probably seen the movie, right, with Brad Pitt and Jonah Hill. So, a baseball team starts using these statistics systematically to draft players and evaluate their decisions instead of kind of the old school conventional eye tests that of the scouts used to deploy, right? Oh, I'm telling you, he has a good swing, right? And as a result of that, they're able to spend a lot less money. I think, if I recall correctly, the Oakland A's spent, had a budget 3 times less than the Yankees, and they kind of outperform with this team of misfits in a similar way that we look for mispriced risk. And so Moneyball for us is every year we make these kind of buy and sell decisions, and they're ranked by the dollar alpha that they contribute to kind of the strategy and the portfolio. And a few things I would just mention that we're conscientious of when we look at these statistics. One is, Annie Duke talks about this great concept of resulting, where we have this kind of dangerous heuristic of assessing the decision quality by the result. So good result means good decision, bad result means bad decision, and so the problem we have here is that the future is uncertain and probabilistic. So at the time of the decision, the odds could have been in your favor. So you made a good bet, but you had a bad result, or vice versa. And so you might overfit the decision quality with the outcome. Then your feedback loop kind of gets distorted and you're learning kind of the wrong things. And another thing I want to just consider here is in the context of being long-term investors, the shorter the time frame you look at, the more noise it starts introducing. So we start to get a lot more signal when we look at 5 years plus. And let me give you an example. In 2019, we bought Couche-Tard, boring convenience store operator, number 2 position in the US, in a very fragmented kind of landscape of convenience stores. And if I transport you to 2019 and we open up the Moneyball stats, what you'll see is if you go all the way down to the bottom, the 4th worst contributor in dollar alpha was Couche-Tard in 2019.
You're saying when we initiated in the position, off the bat, it didn't go so well.
Yeah, exactly. I mean, and you open up, so you get the Moneyball stats. So from the beginning of 2019 to the end of 2019, Couche-Tard was kind of the 4th worst contributor with negative alpha to the portfolio. Fast forward to 2023, you go back to that 2019 sheet, but in 2023, and you see it's actually the 4th most positive contributor in the 2019 decisions we made in terms of contribution to the portfolio from a dollar alpha perspective. So so sometimes great investments have this short-term negative momentum going against you, right? And so just having a long-term perspective. I'll keep going here a little bit with some other patterns, from Moneyball. A lot of the large contributors to the strategy were really consistent with our philosophy. And so, for example, we bought Microsoft in 2019, and Microsoft, if you transport yourself back to 2019, it was far more boring than it is today. It was just, it was a good business with a good management at a good price, but it was not the largest company in the world with kind of sexy AI behind it, or this kind of cloud emerging kind of at the forefront of cloud in a big way. Or how about Novo Nordisk in kind of 2020? Back then, it was pretty boring. It was the number one insulin and diabetes manufacturer, super focused on the molecule and the research, great engaged owners with Scandinavian governance, but obesity was just an optionality that got realized over time, right? But it was super boring at that time. We do have some new ideas in late 2021 that haven't gone so well. 2 years later, I would say we're still in the early phases of being able to talk about them. But I'm going to keep going here, Rob. But I want maybe I'll get off. I haven't talked a lot in the last few days, so maybe I'll get off my soapbox for a second. But I do have some more stuff to talk about Moneyball.
It sounds like one of the real insights that Moneyball provides relative to more traditional Brinson attribution would just be the ability to decompose decisions by vintage. So you can separate kind of your shorter term decisions from the longer term decisions. Am I right?
No, absolutely.
And I was going to say, but another aspect of Moneyball, I think, is this ability to distinguish between, okay, a decision to do something versus a decision to do nothing. And I wonder if you have anything that really came out of the past year that fits into that camp.
Yeah, that's beautiful. Yeah, that's another interesting thing we do, Rob, is we have all these different states of the portfolio that we can benchmark against. And you can think of it as kind of having these alternative histories to assess our decision making in. And my favorite one is, hey, what if you just did nothing? Like, what if you just went to Mexico, laid on a beach, just sat on your hands? And it's always humbling when you underperform that alternative history, which is just don't touch it, right? And we have in the past, in a few years, we've underperformed that history. And we do it in different variations. You can do it kind of starting at the fund weights or doing it, hey, what if we equal weight, but you did nothing in the beginning of the year? And that's also pretty humbling because if you underperform kind of the equal weight, which means your position sizing might be a little bit off, or you're not really creating a lot of edge in your position sizing. One interesting observation in 2023 was that this was the first time since we started doing this exercise in 2019 where our portfolio outperformed every possible state that we contemplated in the Moneyball strategy.
And okay, now so coming into the office this past year was a good decision.
Was a good decision, which thankfully, because it justified my job for 1 year, but it may be luck or just randomness, Rob. But I do think we've made an intentional and considerable effort this year in increasing the hurdle rate when we make decisions. We often talk about inactivity being kind of an intelligent behavior.
That's sort of a weird thing that Moneyball is suggesting, right? It's saying that, hey, if you had just done nothing, you would have been better over the last few years than what we did. But like, I don't think that's the full picture, right? Because the strategy has still outperformed its benchmark over various periods of time. And so it's those initial decisions to stick with things in the first place that are driving value. I just wonder if you can maybe shed some light on that aspect of it, because I think a lot of it just comes back to the philosophy itself.
Yeah, absolutely, Right. I think Peter Lynch said it kind of well. He said that the most important organ in our body is our stomach, not our brain. And the big profits really come from kind of owning great businesses and not really trading them. And we don't want to confuse kind of action and motion with progress. So sitting on your hands is probably the toughest part. And I'll give you one example, tying it back to Moneyball. Here's a boring company for you, Wolters Kluwer, professional publisher with these workflow solutions and databases for professionals like accountants and tax, health professionals, lawyers for reference, so they can reference case law. And that's a stock we held, nearly 7 years. And it's undergone this transition from print to digital over time. And so it's a really boring company, nice, sticky kind of subscription revenue. And you go back to our 2017 vintage in Moneyball, and you see that it was a top contributor in terms of dollar alpha contribution to our strategy. And again, a lot of the money is made by being right and sitting tight. As in the reminiscences of a stock operator, Edwin talks about that. It's not your thinking that makes the big money. So I think, hopefully we had the stomach to hold that for kind of a longer period of duration. And I think that's our intention.
I want to go back to something you mentioned briefly, Because I know we're also at a time of year when you're reflecting back as part of our post-mortem process and thinking about things that went wrong, stuff that you've learned. You mentioned some decisions in late 2021, if I heard that correctly, that haven't played out yet the way that we hoped. Um, can you talk a little bit more about those, and are there specific post-mortem learnings from this past year that tie into those?
Yeah, one of the things we considered is, typically there's two points I'd say to this, Rob. Is one is, we typically shy away from businesses with poor balance sheets. But our mental model is usually we don't want to take both operational and financial leverage. So you don't want a business that's volatile on an operating leverage perspective and has financial leverage. That's a double whammy. That mixture is a nay for us. Yeah, pretty toxic mix there. So the businesses that we bought, like Organon or Dun and Bradstreet, they had a leverage on the balance sheets, but both businesses, if we think of Dun and Bradstreet, really recurring subscription revenues, very sticky, high retention rates, 96% plus.
This is the commercial credit company, right?
Yeah, so that's the number one commercial credit bureau. And then you have Organon, which kind of had this branded off-patent portfolio in niches of drugs, as well as kind of innovative, women's health and biosimilars part of the business. So not growing much, but a portfolio of assets that pretty resilient and defensible when you think of kind of drugs and pharma. But the leverage in that environment didn't work very well, and so despite kind of having this mental model, I do think that we put a bigger emphasis on their balance sheets were a little bit too offside, and it's one of those lessons you do it anyway, and so in hindsight, I think you kind of it's recalibrating that again and kind of make sure you're conscientious of that balance sheet. It reminds me of how lessons can be so fallible, right? I mean, Stanley Druckenmiller, famous kind of investor, trader, however you want to classify him, but he talks about how he learned nothing from investing at the peak of the dot-com bubble. Because he says, I already knew it was stupid. I already knew it was folly, but he did it anyway. And so a lot of times the enemy of our client's capital is really our own emotion, Rob. So it's not what we know, but it's what we do and how we act. And so that's one perspective. And the other perspective is in the desire to kind of move off of some of the higher duration names, we may have made more decisions than we intended to. We were more active because typically the constraint or the bottleneck is the other side of the trade. And so sometimes it's better to lean into your existing ideas and say, hey, you're always swapping one risk for another when you do a buy and sell decision. Right. So when you sell something, it means you're buying something else and you're swapping risk. So just being more mindful of leaning into something instead of kind of going away from it. And so that's really where kind of having more inactivity, I think, has been really a motto for us in increasing the hurdle rate.
I want to stay sort of on the subject of portfolio construction and risk, but I want to shift to looking ahead here. And I think last time you were on the podcast, you talked about various ways in which you and the global team are kind of slicing the portfolio to evaluate the balance and the risks that are there. In the past, you talked about economic sensitivity. You talked about alignment, skin of the game. One that I heard you talking about internally a little bit more lately was asset intensity. Can you describe why that's so important in a risk management process and what the portfolio looks like from that perspective?
Yeah, absolutely. And I think it's, Rob, if a monkey can see it, then there likely be not much value add. So, Nassim Taleb calls this kind of statistics from the cookbook, right? And so you kind of just get in this plain vanilla, it's already calculated for you. You kind of see it, it's a correlation or a PE or whatever it is. And you kind of superficially look at that number and you make a judgment from that. But the key is in our kind of risk management process, and it's very dynamic. So we try to do new exercises. The key is to have this criteria that's not visible at first glance. You can't just look at the portfolio and say, oh, yeah, X amount of your portfolio has this asset intensity or skin in the game. That requires kind of a little more deeper dive into the portfolio and some judgment. And that's where we think judgment can lead to an edge. The outcome of that that exercise was, our portfolio bias is towards asset-light companies, and this is consistent with our thinking. Um, Roughly 90% exposure of our portfolio, and again, this is my subjective opinion on the strategy, or our subjective opinion on the strategy, kind of had no to little to average asset intensity, so relative to the universe.
Do you have a sense like how different that is than kind of the broader universe? Like has the just with more and more technology, has the universe kind of shifted that way as well, or is this really differentiated the way we've got the portfolio?
I think in part the world has shifted there, particularly in the U.S., more service-based economy, and you can see that. Um, but I do think I do think that our philosophy, which emphasizes wealth creation, does create a selection bias where we which is intentional, which is that businesses that don't require a lot of capital to grow, well, who knew? It tends to be more wealth creating, and they don't got to reinvest a lot of money to maintain their revenue base. And so in an inflationary environment, that's also quite positive, because as your maintenance expenditure goes up with inflation, you got to spend more and more just to reinvest, just to maintain your revenue base. And so we like businesses that don't have a lot of capital to grow, and that tends to be more wealth creating. But I do think there's a structural shift in particularly the developed economies towards a more service based, but not everywhere. I mean, I think it's particularly acute in the US.
One last question for you, which again is in the forward-looking category. We've got a platform here to speak to folks who are invested in the global strategy. What are you thinking about the most, and what message do you want to leave with clients as we look forward to what's always an uncertain year?
Yeah, what's the name of this podcast going to be?
Okay, expecting a predictable response then.
Play the plan, Rob. We'll continue to be boring and play the plan. No, look, being boring to us is making repeatable good decisions over time with a really well-defined investment philosophy and process. And that tends to lead us to boring, defensible, resilient companies. And we're a special bunch of people because we find boring exciting. And I think that's the message, that we're going to continue to be consistent with that.
Well, Manar, your voice sounds just fine. I'm glad you're fully recovered, and many happy returns for the year ahead.
Thanks, Rob. Appreciate that.